the Moneyweb Crypto Podcast, where we discuss all things crypto related. Your host, Kieran Ryan.
Who would have thought that hardware wallets may no longer be safe for holding Bitcoin? We always assumed hardware wallets were one of the safest ways to hold your Bitcoin, chiefly because the private keys remained offline, away from the internet and beyond the reach of conventional hackers. But that assumption has been shaken by a serious flaw affecting certain cold card wallets. Now, this was a firmware error dating back to 2021, reportedly caused by some devices unable to generate sufficiently random and therefore potentially predictable recovery phrases. Attackers were able to reconstruct private keys without gaining physical access to the devices and drain an estimated 1,367 Bitcoin, worth close to about $90 million, and that was from more than 4,500 addresses. Now, the incident raises an uncomfortable question. If Bitcoin can be stolen from a cold wallet while its owner does everything apparently right, what does secure self-custody actually look like? We're joined once again by Shiven Mudli, founder of blockchain analytics firm Novake, to explain what happened and what we can learn from it. Hi, Shiven. Good to talk to you again. But let's start with the mechanics. How were the hackers able to steal Bitcoin from these cold card wallets and without physically accessing the devices or obtaining the owner's recovery phrases? So what actually happened there?
Yeah. So, hey, Kieran, and hey, everyone listening. Overall, this was a firmware issue, meaning that when there was an update done to these wallets, particularly if you have an MK3, MK4 wallet or MK5, those are sort of the duration in which people were looking at. And if you bought one of these cold wallets, hackers were able to simplify the maths in order to get those private key codes. I like to think about it as a deck of cards. A deck of cards, there's 52 cards, and in order to understand the output, it is quite complex. However, this deck of cards in which the firmware was updated was only 20 cards, meaning that the output was a lot more easier to get in terms of generating multiple probabilities rather than using 52 cards. In this example, anyone with an MK3, MK4 wallet that would likely be hacked, it's important that, or the function of that was your private keys being hacked through this technology. And it poses a really grave concern because hackers could have ideally used an open source AI model in order to look at backend architecture, in order to find the gaps and then sort of exploit that from then onwards. So no one's wallet was really physically touched. It was more a private key, and then you're swimming in a pool of dormant wallets that were likely using this infrastructure.
Yeah, I mean, it appears to be a weakness in the way that these cold card devices were generating the recovery phrases rather than a failure of the Bitcoin blockchain itself. So maybe just spend a minute explaining that distinction and why supposedly random keys were made predictable. I think you gave a very good example there of a deck of 52 cards, but you're only dealing with 20. Of course, it becomes mathematically a lot simpler to do that, but this does not affect the Bitcoin blockchain itself, right?
Correct. When looking at blockchain as a whole, the network is significantly secured in a manner. However, when we're looking at these cold wallets or we're looking at providers, and I think a lot of cases people are going to be considering, what about Binance's cold wallet am I looking at? What about CASPs in South Africa that are offering me cold wallets or custody wallets? What does this mean and how do all these things work? Well, in the case of why this case particularly is so big, it's that the cold card is the first hardware sort of infrastructure to be hacked at this level and at this volume. The previous hacks obviously were FTX, Mt. Gox, those are examples. But in this case, the firmware was the problem. The device was the problem. When someone buys this device and they set up the wallet goes through this process of, one, you can create your unique private key. So your private keys are a set of words in which are generated. And in this case, it was generated by that little cold card device. That little device, when updated, there was a bug within the software, which likely could have been human error, was not secure in a level that supposed to be. So meaning that the entropy of the function of the security of the wallet was not as a substantial level as it should be in cybersecurity. So when this wallet was hacked, that was the primarily the biggest blocker.
What does this mean for people who are looking at self-custody? And of course, in the Bitcoin community, self-custody is almost a mantra. They advise it repeatedly. What does this mean? Okay, let's just distinguish here. This has only affected certain cold card devices. You've got other hardware devices like Ledger and Trezor. Are these still good? Are they still safe?
My advice is always be cautious when you're moving money right now. In this case where you could have been likely impacted by having an MK3 wallet or an MK4, MK5 wallet, it's best that I think there was one announcement that MK5 is on a lower tier, but it is exposed within the ecosystem. So it's important to still stop what you're doing and really check out your wallet if you do have any of these cold wallets. It's important that you need to remember that the seed phrase is the problem. So just going back to the seed phrase, one thing I missed there is the device produced the seed phrase, and that seed phrase, because think of it as the 52 deck of cards. It didn't have 52 cards. It had 20 cards that was fragile, and that allowed it to be exposed within the environment. However, people that used something called a rolling dice function, which are more experienced users using cold wallets, within that ecosystem, they had a second layer of protection. That means maybe a password. They generated a particular key, which is a random number in which kept them protected. However, when moving money now, it's important to remember that if you're taking another wallet, ideally your seed phrase might be the same, moving from wallet to wallet. So it's important to check how exposed you were. It's important. But the problem that also Cold Card has is they did not keep the privacy information of these people. It was ideally burnt. So that means that they can't report to anyone who has these wallets, this is your wallet that's impacted. So this is the shortfall equally on the blockchain system on the privacy side in terms of the ownership of the cold wallets. Then moving forward into the aspect of moving money from your current MK3, MK4, MK5 wallet into a Trezor, into an exchange, it's really important that because you might be frazzled at this time, do a small transfer before you actually do a big transfer to those wallet addresses. Ensure that wallet is secure. You create new keys. Everything is private and allows you to really test that function first. If you're going back to using that self-custody tool, that hardware wallet, just be sure that you're re-looking at your private keys. You're regenerating a completely new set of keys for that wallet exposure.
Right. Now, I see some people have been putting out newsletters and messages this week saying that, well, maybe what you should be doing is moving back to centralized exchanges. One of those who was making that call was Dan Held, who used to be quite famous in the crypto space, which is a turnaround from what we have heard people saying over the years. Put your money back on a centralized exchange because they invest massively in security. What do you think about that idea?
It's sort of a catch-22. One, centralized exchanges do pose the same risk. I would say a level of risk that might happen again in firmware called wallet storage. And where we see that is centralized exchanges own their own keys. And this is a case of, I think it was one of the hacks previously where it was social engineering within a website, and then that money was moved through the exchanges. FTX was within its own fault. But we've seen centralized exchanges being exposed through social engineering in this case. When we're looking at the next stage, and I'm going to put on my compliance hat here and think about a case of South Africa. So CASPs, ideally. CASPs that are using, let's go with maybe a Chainalysis or Orca or even 5 blocks with this case. The architecture in which that runs on them is Chainalysis is monitoring those transactions, or Orca is monitoring those transactions. And then Fireblocks is running where there's they call it MPC, sort of infrastructure in which the keys are segregated across a variety of segments or users. That allows more security. Yes, centralized exchanges are great. However, they also have their equal flaws. But it's important to understand that if you're keeping money on centralized exchanges, whether that be anyone in South Africa, anyone globally, that there's a level of insurance. There's a level of insurance that they've insured their private keys, they've insured their exposure. It's very important. I don't think we talk about it as enough as within the crypto space, but CASPs, I'm sure it's important for them, but also anyone holding custody services. It's important that you question, how are you insured? Why, what are you insured up until, which is important, and what is insured? So that means that they could only have insured their private keys, meaning that if a hack happened on your account through social engineering and they got their private keys out of you, you can't claim from them in maybe a legal battle. But if there was social engineering on the CASP side or the VASP side, they likely would have to call upon the insurance because they're exposed to their private keys. And that's what led to the loss of capital.
All right. So it's important to find out from the exchange you're using, what exactly is their insurance and how much are you covered for? Let's talk about blockchain analytics firms like yourself, Novake. Are you able to monitor these things in real time, know when an attack is actually on? And can you identify the wallets involved, follow the stolen Bitcoin, and determine whether it's the same attacker behind the different waves of theft?
As an analytics firm, we don't do the criminal side. We're not really focused on the criminal side. However, if you pull up, let's say, any sort of blockchain analytics platform, maybe like I would say blockchain.com, where you can see all the transactions, or you pull up Etherscan, SolScan, they have a level of what is maliciousware and what wallets have been flagged. And if you use AI, you can categorize those transactions and ideally follow the money. I had a very similar case where a wealth manager in South Africa that's using one of our platforms, Via, reached out to us because they were onboarding a client who was previously exposed to a crypto scam, and it was ongoing and no one could do anything. And we showed them, without the use of fancy technology, because we don't have the Chainalysis or the fancy technology, how to use actually blockchain.com and follow the money. So meaning that if you generate a transaction and that transaction happened and it's registered on blockchain, you can copy that transaction ID, paste it into blockchain.com, and then follow the money in terms of how it went. And this depends on whichever chain you transacted on. So that's also a really great opportunity. But from that perspective, looking at it, the live movements, we can do it. It's very time consuming, but you also have to know who those addresses, ideally, is it maliciousware? Sometimes we don't have those flags, but a lot of the criminal softwares, Chainalysis, Oka, all of them show those criminality checks.
All right. Now, let's see, if you've got a cold card wallet, what should you be doing in terms of precaution going forward? Are the firmware updates and new recovery phrases sufficient, or should serious investors consider multi-signature wallets, passphrases, and maybe even spreading their holdings across different devices?
I would say slowly start to look at maybe transferring your money out of the cold card wallets right now, just to be sure, just to be safe, because you might be a beginner using cold wallets and you might be exposed. But for the more sophisticated investors, they would obviously have multi-signature functions within these wallets. But if they don't, they should be considering multi-signature. Multi-signature is a really great way in order to segregate exposure, but also to segregate risk in terms of it's not one authentication functionality. So think of it as two-factor authentication. But multi-signature is something that's very important that we're looking at across the board in all startups that we run as well to support those sort of functions.
I know that the exchanges all over the world are now, they've taken note of this and they're looking at their own potential exposures. They're always doing it anyway. But I think what emerges from this is better and stronger levels of security. Mm-hmm. So I think this is, that's fairly good advice. Multi-signature, meaning before you can do a transaction, you've got to have maybe 2 or 3 people authorizing the transaction before it can actually happen, right? Mm-hmm.
Yes, correct. And it's important. So you could have a second device that's authorizing the transaction and vice versa. So if you're transacting on your phone, you could have maybe another plugin, a web device or anything like that to verify, or another user. And that's important. A very popular one on Solana right now is Squads, but there's also a variety of multi-signature wallets that exist within the market right now.
Shivan, let's close off with just a general discussion about what's happening in the crypto market. I mean, there's tremendous amount of apathy. The Bitcoin price is down. It is trading at $62,000 today. That's about half of where it was back in November last year. And of course, with the altcoins, the smaller coins, they're also very, very heavily down. Some of them 90, 95%. What's holding the market back, and could an incident like this undermine confidence in self-custody further and delay a recovery, or is it unlikely to have any lasting effect on prices?
I don't think the wallet function right now, or the wallet hack is to do directly with price of Bitcoin right now. We haven't really seen a major change in price since the hack. The hack is a lot, or the price action has a lot to do with what's really happening with exchanges, how liquidity is looking at, like on exchanges, how open interest is really translating through the market. I think the biggest fear in the market recently was recent activity from the strategy team, MicroStrategy team. That was very interesting. We saw a lot of movement, a lot of conversations around there. But when we start looking at the market as a whole, I don't think the hack is directly attributed to where price is. I think if price wants to go higher, right now we need to see a lot more confidence in terms of the flows within that. And that's a big demand. That's a big sort of question right now. What's happening in Korea from a macro perspective on that slump that we saw on the AI crash, you'd know that Korea or Asia as a whole is a big crypto demand. It's a heavy gambling sort of function in terms of how people speculate in the market, particularly as well. So we saw some significant movement from there. On-chain, there was some activity that did come from those chains of activity, but we're still seeing a lot of the dependent or the speculation and sort of this reflation period coming from a lot of the macro environment, both across the states, Iran war, oil, and just general demand and sentiment.
Just very quickly, tell us about your latest project, which is called Veya, Veya, which is basically a tool or a platform for family offices to manage both crypto and traditional assets. What does it do that's not available out there?
What we currently doing there is we're using behavioral economics, such as fancy econometrics and math, to actually ensure that wealth managers proactively manage their clients, but also prevent drop-off. So what that means is we use live data interpreted from open banking rails, and we translate that into how does economics really impact the client. So they don't have to buy a policy where they may drop off in 3 to 5 years. There might be longevity within the product. So it allows them to manage work staff and advisors more actively, but also keep their operational expense low through the technology. So all of this is done through math. And we're happy that we've been running for a while. We got Startup of the Year, Top 10 Startup of the Year for Innovation City in Cape Town. We're now nominated for Digital Asset Platform in Ireland, so which is really great. And we're making strides. We have some pilots running in South Africa. And if anyone wants to be in touch looking at the platform, calculators are free to all the retail audience, so you can manage and look at your wealth and situations. And if any wealth managers or any advisors want to look at getting involved in the platform or use the platform, more than welcome to reach out to me, and I'm happy to give you a sandbox environment to test it out, to get to see how much value you return out of it. Because we know 2 of our pilots are doing really well using the technology, but it's fully digital asset function as well. So meaning that you can offer your customers digital assets, and you can leverage the knowledge from Novak using on-chain analytics to advise your clients on best strategies, how to think about on-chain and crypto, what are the assets you should be holding, how you should be holding it. It's really simplifying that entire process to take the wealth managers from traditional all the way up into digital, self-custody, tokenized funds, and proactive wealth management at a fraction of the cost and fraction of their time as well.
Very good. We're going to leave it there. That was Shiven Mudley, founder of blockchain analytics firm Novak. Thank you, Shiven, again for your time.
Thanks for listening to the Moneyweb Crypto Podcast, hosted by Kieran Ryan. To listen to our other podcasts, go to moneyweb.co.za or the Moneyweb app and follow Moneyweb News for daily updates.